Welcome, everybody. My name is Bob Klefsaas, president of All Star Financial. I want to welcome you to the fourth quarter 2015 webinar that basically goes through our newsletter. The title of our newsletter is The Stocks Rebound as Interest Rates and Oil Prices Drop. Interest rates rise and oil prices drop. 2016 came in with a bang, literally with China scare. Want to make sure that our email to everybody on January 7th was read. The China sell-off really not a sign of really what the valuations are there. It's really an opportunity. And we want to welcome our 10th member to our team, wealth manager, graduated from Penn State, Nick Sullivan. Previous experience was out east in Philly. He worked for Vanguard. His duties here are going to be client-facing and 401k duties. So you'll expect to see Nick quite frequently in front of you doing quarterly reviews. Market overview. Slow growth, diverging monetary policy between the U.S. and Europe, however. First time in 8 years where we've seen a rise in interest rates. We're seeing that obviously up and against some very susceptible growth, only 2 to 3%. First time ever where rates were raised with GDP less than 3%. Not sure it's going to work. However, when we look at Europe and Asia, they're taking a different path. There's still monetary easing programs there, along with lowering of interest rates. They also have a stimulus bond buyback program. We believe it could result to significantly better earnings and significantly better performance. Crude oil prices, when we look at crude, obviously that $35 a barrel is going to help us as consumers. It's going to help the benefit of us is going to be probably not as good as the loss, however, for the energy companies. We might see some fallout in bankruptcy. Yet another year in 2016 of domestic lofty valuations versus international being undervalued. Let's look at international as we go. U.S. economy, the consumer is really still the key. A lot of good news. We got healthy job market, which has been the case for many quarters going back. Consumer strength, excuse me. We see personal income up 4.4%, the personal savings rate, all of those positives. Automobile versus what we've seen in the past, out to almost 18 million annualized in the last quarter. Home sales have been up. Price of existing homes has been up. A lot of very, very good positive. Bad news, however, we have a strong dollar that consumer is going to benefit from. However, we're going to see the profits on the S&P 500 decline because of that, with overseas sales declining. The U.S. economy going forward, then, we again believe the consumer is still really the key. And that consumer that being the key, we want to make sure that you go out and spend your oil dividend. Business spending is going to be muted again because of the overseas sales being a little bit lower. Inflation is really not an issue. We sold about 8 to 12% of your portfolio off. That was right before the end of the year. So we have a lot of cash position, which is good. Growth expectations are going to be slow and muted, so that we took those inflation exposures off the table. Good news is we have bipartisan budget deal that's not going to have to roll into next year and have to worry about that during an election year. When we look at the bond market going forward, interest rates go up, bonds go down, and that was actually the case. We saw almost universally every bond index go down. The one that was biggest hit, obviously, were the energy sectors, minus 8 to 20% downside. Expect some bankruptcies there. Top performers were the exact opposite from last quarter, which were the worst performers. Emerging markets and municipal bonds were positive, a little over 1% each. When we look at bonds going forward, we really believe the Fed's going to be slow in actions, and hopefully they do raise interest rates. That means I'm wrong and the economy is doing a little bit better. But if they do raise interest rates, it'll be slow and moderate. And again, it's going to create and keep that opportunity to buy bonds at a pretty good value right now. Our exposure is really short-term, floating rate, and emerging market bonds, all that perform well in a rising interest rate environment. Bonds are still a hugely valuable diversification part of your portfolio. And really the first 6 days of the market that we've seen can't represent that even any more realistically. Domestic stocks, we look at the domestic stock market, we saw a fourth quarter rebound. That fourth quarter rebound showed the large cap 1000s up 7.4% after a tough third quarter. Mid caps and small caps were up about 3.6%, but broad market growth was up 7.1 and broad market value only up 5.4. So growth outperformed value. Technology did a phenomenal job, as well as healthcare, materials, industrial, and consumer were up 8 to 10%. Most energy stocks were flat, obviously, with the decrease in the oil and the susceptibility to bankruptcies for energy companies, but we saw a positive utility exposure there. Domestic stocks looking forward, we think there's going to be marginal U.S. stock market returns going forward. As we said, corporate profits are going to be muted with the higher financing, the stronger dollar, the pressure on increased wages. Technology and healthier consumer financial could drive returns, however, and we're allocating and shifting our exposures to these sectors as we talk. International stocks, again, better buys because they really haven't grown as fast. So the robust rebound that we saw in the U.S. wasn't quite there in the international, particularly in the emerging market, was only up 1.8% for the year. The MSCI Europe large cap and small caps were up 4.9 and 5.8 respectively, and the broad market index BMI S&P up 5.7. We saw Japanese stocks perform really well with the weaker yen and fiscal reforms, along with other European countries doing the same interest rate cuts. China, mid-year sell-off, it did bounce back from there. Obviously not as much as the sell-off at only a positive 5.7%. Latin America's decline, in large part because of the Brazil recession that's going through. And again, not a lot of exposure in either Brazil or Russia, but those are two countries that are going to have their concerns going forward. International markets looking forward, expect further stimulus efforts. Again, abroad, most central banks are easing buyback programs on bonds. We think that has a potential 8% or more jump in corporate earnings for the European and China stocks. So again, we feel like our exposures there are really good exposures that haven't really been rewarded quite yet. Foreign stocks are attractive. You know, when we're value managers, we want to buy low, and believe me, the market is low right now, significantly more valuable or of value than the U.S. stock market. So in summary, when we look at the fourth quarter and really the whole tumultuous year, we had a lot of things that drove that tumultuous year. Oil prices, our first major stock market correction, Federal Reserve, uncertainty whether we go up or down, and interest rates. I don't think that that's going to change in 2016. Market doesn't like uncertainty. I still think there's going to be a lot of uncertainty. We may see the market shift away from what monetary policy can do to actually what might real organic growth look like. And if we don't get that, there might be some tumultuous downside. We're in the seventh year of a long recovery after a really deep recession. So we are right at that top. That volatility and top has created a 2-year time period where market's really flat, and leading into a election year might be flat again. One of the benefits that we think value-driven money management brings to the table, however, is it takes away that emotion and that fear and greed decision-making process. And when you look at the emerging markets, they are of value right now. 19.1 PE ratio in the U.S. compared to 11 in the emerging markets, about a 40% discount. We're going to plan to maintain our allocations at a 6 to 12% allocation across our 4 models because, again, value is really there, and the growth opportunity is by far much better. Again, challenge and opportunity. When we look at the market and the emerging markets in 2015, we had some pretty significant swings where we saw the international markets as of about April 28th go up to a positive 14% year to date, where the domestic market at that time was only up 3%. If we would have ended the year there, we would have looked really, really good, our returns. However, we saw the decrease in susceptibility to volatility when markets don't like uncertainty. Emerging markets didn't like it significantly more than the domestic market. We saw a 19% slide to negative 19 in its August 25th trough. That matched itself at the end of the year. So there's a 33% slide from its peak to its end of the year valuation, where the domestic market was only about a 6% slide from positive 3 to negative 3. So when we look at it, the international markets, they do have a lot more volatility, but with that comes basically what we believe to be opportunity, and a good opportunity going forward. Restaurant recommendation, this is kind of our fun part of the newsletter. Ask for Rocky at Borders Pasta Bar. I can guarantee you it'll be one of your favorites. Newbie Nick Sullivan, our newest employee, is bringing a chicken and broccoli hot dish to the equation. And again, one of my favorite people to quote is Winston Churchill. He talks about pessimists seeing things, or pessimists see difficulty in every opportunity, and where the opportunists or optimists see the opportunity in every difficulty. So again, we want to look at this year as exactly a positive scenario. And thank you again for your trust in the All-Star Financial team. Remember, our referral program can reduce your fees. We've been very, very successful there. And again, adding our 10th member to our team is, we're here, and as a differential from All-Star Financial to most people, hopefully you see that service mentality that we have. Please do not hesitate to give us a call. Hopefully you've enjoyed the webinar. For those clients that have been clients a long time, thank you. For people who are looking at our webinar and saying, hey, is All-Star Financial the team I want to join up with? Hopefully it was a benefit to you, and we'll look forward to talking to you next quarter.